So my biggest fear is that at some point there's going to have to be a financial reset where, all these countries that have just printed and taken on massive amounts of debt to GDP, there's some sort of collapse that it creates the birth of some new sort of financial system, some with checks and balances where governments have to have a balanced budget by law, stuff like that. But it does bring up the question of, number one, physical metals having a bigger role in the future, and then also cryptocurrencies and things like Bitcoin maybe having a bigger role as well in terms of backing the US, right? I mean, imagine if there was, maybe this is where the CBDC comes into play too, where it almost rescues the financial system, but it rescues it with predetermined expansion to it, right? So for instance, imagine if the monetary supply was only allowed to expand, let's say 2% a year versus the government being able to just print ad nauseum, or the Federal Reserve being able to print ad nauseum. So my guess is something like that will occur. The problem is to get to that point, we are going to have to go through something that's very akin to the Great Depression. And I worry it could be even worse than that. And so there will be a lot of growing pains. And this is what I've always said about the Federal Reserve intervening, is that in general, it creates a scenario where you don't allow the natural course of economics to play out. Like if you look at cycles, the seasons, the solar cycle, the lunar cycle, everything has a cycle. We all have cycles in our lives. The economy has a natural cycle. It has expansionary periods and contractionary periods. When you don't screw around with the cycle, the expansionary periods are solid. The recessions are lukewarm. They're not horrible. When you mess with the cycle and don't allow recessions to occur because you print right away and you just lower interest rates, then when we do get one, it's 10 times worse. Think about it like this. If someone never got sick and they were kept in a bubble and all of a sudden they were removed from that bubble, they would get so much sicker because their immune system was not actively made to combat those issues. And that's now what we have in this financial system and really globally with many countries out there. When things collapse, if it does cause something like the Great Depression, there's very few people that are alive now that have experienced or gone through the Great Depression. And I think that is what they always say is, every generation has to experience it. So we're kind of at that cycle turning point where you almost have to expect it within the next 5 or 10 years. But I think the uproar from citizens of the world, and that's the US and probably Europe and the rest, what we're going to go through will be so blatantly obvious that it was mismanagement from the Federal Reserve as well as the government that I would hope, and I say hope because you just don't know, but I would hope that the demand from people will be such that the curbs will be put in to make a system that is actually solid. So I'm hopeful that we don't have to go through two of them, but just like always, in 100 years later, it is have the rails come off. Like I remember vividly when going back to 2008, 2009, banks were failing and Dodd-Frank was introduced and they were like, we can't have any banks that are too big to fail. We can't have any companies like that. We can't go through this again. And here we are with banks that are even bigger and more leverage in the system. And heck, now we have companies like Apple, Microsoft, Nvidia that I guarantee are too big to fail as well. And so it shows you how short-term people think. People forget things so fast. And so you're right. Maybe we have to go through it multiple times before it truly is fixed. I think on the positive side, the data up till this point has kind of allowed them, right? Inflation stayed a little higher, so they can say, oh, we can't cut rates yet. And at the same time, the economy's staying relatively strong, so they don't feel the need to. I did see Neil Kashkari over the weekend coming out and saying that we won't cut rates likely till December. And again, that perfectly puts it after the November elections. But the question I have is, well, what if the stock market collapses 10%, let's say over the summer? Are you really going to hold back to that? What if we start to see unemployment skyrocketing? So I think they want to try to remain neutral because, needless to say, especially here in the US, everything is so polarized at this point that no one wants to step in the middle of that. So they would prefer to wait to December. The question is, are they going to be able to? And if they, this is the kicker, is that even if the data shows that they need to cut or they do cut, it will be made into a political thing if it's done before the election, because that's just the way our media is and our system is at this point. But I truly believe that they don't want to mess with that. If they're like me, man, you just want to stay out of that whole mess. It's just a nightmare, to be honest. Yeah, it is really interesting. I know with Canada cut rates recently, as well as the ECB, and it is interesting to see these other countries already starting to move that direction. It's probably because their economies are showing a little bit more weakness than ours, and there might be more stresses that they're seeing in the system. But again, it's one of those things where every time some other countries cut rates, it does make it easier for the US to say then, okay, well, now we have to compete essentially, and therefore cut rates. So I think that's just the beginning of the ability for the Fed to start lowering rates later this year. This is, I've heard rumors recently that the big players like JP Morgan are unloading some of their bad debt because they know what's coming, but basically you have a scenario here where in a weird way, it's almost worse. It's different than 0809. In 0809, it was people's homes that really dropped so significantly where they had taken out zero down payment mortgages and stuff like that. In this situation, it's more with interest rates where they are. A lot of these mortgage-backed securities were priced and put together when interest rates were 2% or 3%. And so there's massive losses sitting on these banks' balance sheets to the point where I call them zombie banks, right? If the Fed didn't bail out or the FDIC didn't bail out the depositors, you would see more bank runs going on. But the bailouts of those depositors kind of calm the nerves. Everyone now thinks, hey, don't worry, you'll get bailed out no matter what. So that creates these zombie banks that can still operate even with massive losses. And then here we have incredible losses looming on the commercial real estate side. I mean, you go to strip malls, you go to malls, there's like 50% vacancy rates where there is so much dead paper there that's at down 60, 70, 80%. But again, as long as they hold it to maturity and there's no hiccups along the way, meaning the economy stays strong, they can kind of weather these storms. But again, one sort of blip, one sort of black swan event, and this all comes crumbling down. And again, some of the losses are rivaling what we saw in 0809 in terms of what they're holding. It just hasn't had a trigger yet to cause a collapse. It's one of the fears that we talked about just earlier is that every time the Fed gets involved, it allows bad actors to say, well, they saved us again, so why should we worry about the risk? Let's just take more leverage, more risk. And at some point, the Fed does lose control. There was a point in 0809 where the Fed did lose control, and I still remember they would come out and say things, and the market would initially bounce huge, and then it would just go down and dive another 3, 4, 5% on the day. And so there is a scenario where you get the Fed to lose control, and then with that type of leverage in the system, it would be a global credit event of proportions that none of us can even fathom. I think that that's the biggest hidden risk that no one's talking about, right? I mean, and the question is then what causes it? Is it China invading Taiwan? If that happens, is it the U.S. economy starting to crumble and the backbone of the U.S. economy, which is the consumer finally stopping their spending because they can't deal with the inflation pressures? Or is it something with Russia and Ukraine? I mean, there's so many different potential risks here, but all it will take is one or two of those. And then once you get players to really pull back really pull back from being involved, that's when the house of cards starts to come down. And again, I'm not going to pretend to know when, right? I mean, I don't know if it's in a week, a month, a year from now, 5 years from now, but it's one of those things where inevitably it will, right? There's just, you can't avoid the pitfalls forever. And the longer it takes and the more money in the system and the more leverage taken, it's going to be worse and worse. And in all fairness, I mean, there's nothing that says gold won't drop if all panic lets loose. We saw that in COVID, right? Initially, gold dropped as well. But it's more that having that something physical that stood this test of time, like gold, silver, platinum, palladium, these precious metals, there's something to them that people have held on for, generations, that there's value there. And then with, to be honest, I wouldn't really mess around with anything but Bitcoin, but in terms of that kind of side of things. But I do think that more and more so that gives us an alternative to the printing of money where you have a stated run on Bitcoin. And so again, it's all about diversifying, right? We buy life insurance, we buy health insurance, we try to diversify out of risks. Well, people have to do the same thing with their financial health and make sure that they're diversified so that if anything happens, you can say, okay, well, I lost 80% over there, but I still have 90% over here. I'm still okay. And again, the crazy thing is that if we do get a credit event like that, that, you would assume that even if gold dips initially, it would skyrocket afterwards and then really make you whole again. And that's why diversification is so important. Absolutely. Here, let me bring up my screen again and we could take a look. Gold is having a small down day. So interestingly enough, I want to show you guys this on the monthly chart. So if we flip to the monthly chart, I want to show you where gold stalled. So we all know it broke out above 2070, 80 or so, and had an epic run over 2400. If we take the high from 1980 right here and we connect it to the highest point here in 2011 and we stretch that trend line out, we did pierce the trend line. But if we zoom in, look at how we never got a daily or a monthly close above that. And I think that's so fascinating to look at how a line going back to 1980 actually capped short-term price. So for me, I look at this and I say, okay, we might have a little bit of consolidation to go where gold needs to just consolidate, maybe pull back just a little bit. But flipping back to the daily chart, if we get rid of this, I think that again, you basically start accumulating somewhere in this vicinity. There's a lot of support around 2185. And then if we ever get back, I mean, this would be a dream. If gold can get back to about this 2070 level, this is what we would call the scene of the crime where it broke out. That would be a huge accumulation zone. So I would say this, short term, I still think there could be minor pullbacks here, little pullbacks, just people digesting the recent move up in gold. But I think mid to long term, gold has $2,800, maybe $3,000 written all over it over the next 6 to 12 months. So if we look at the silver chart, silver had that amazing breakout above 30. It didn't hold, which is a little unfortunate, but it's in this bullish channel right now. And so I'm still a favorable investor on the side of silver. I still think it may come down just like gold a little bit more, but eventually it breaks out for its next leg up. And I think really what you can do is you can go back to, if we go back all the way and look at where this was trading in, 2011 or even the double top, and it's really a double top, you got to think that in the next year or two, with the drop of rates that's probably coming from the Fed, with the printing of money, with the US debt, you got to think eventually silver retests that $50 level in the next few years as well.